At first glance, Starbucks appears to be an unbeatable empire. The company is everywhere, with over 38,000 stores worldwide. Its green siren logo is recognizable across the globe. In the eyes of many casual observers, Starbucks seems to be on top of the world. After all, the chain pulled in massive revenues of around $36 billion in recent years, bouncing back strongly after the pandemic. Its market value hovers near $100 billion, firmly cementing Starbucks as one of the giants of the retail world. Just a couple of years ago, investor confidence in Starbucks was sky high. The stock price hit around $117 per share at its peak, reflecting the idea that nothing could stop Starbucks' growth. The brand is iconic, the cafés are bustling, and the company's presence in over 80 countries suggests it's still winning on a global scale. It's easy to see why people assume Starbucks is still winning. The brand has woven itself into daily life, from morning routines to social media feeds. Millions of loyal customers line up for their lattes and frappuccinos, giving an impression that business couldn't be better. Starbucks' image as the default coffeehouse remains strong. It's often the go-to spot for a caffeine fix or a place to meet. Even now, new Starbucks locations continue to open in cities worldwide, adding to the feeling that this coffee giant is in perpetual expansion mode. By most superficial measures, brand recognition, store count, and sheer ubiquity, Starbucks looks as dominant as ever, a company seemingly at its peak. But behind that familiar storefront and the comforting aroma of roasted coffee, all is not as rosy as it seems. Starbucks' reputation for invincibility masks a number of brewing problems. The truth is that the company's golden image conceals some dark clouds on the horizon, and the cracks in Starbucks' armor are starting to show. The world may think Starbucks is still the reigning king of coffee, but a closer look at the facts reveals a very different story lurking beneath the surface. If you stop looking at the logo and start looking at the data, the story changes fast. Yes, Starbucks is still bringing in tens of billions in revenue globally, but growth has slowed sharply, and in some areas, it's gone backward. In recent quarters, Starbucks reported flat to declining same-store sales in key markets, especially in North America and parts of Asia. Comparable store sales, one of the most important metrics for retail health, have struggled to stay positive once you adjust for price hikes. In other words, Starbucks hasn't been selling more coffee. It's been charging more for roughly the same or fewer transactions. Profitability is also under pressure. Operating margins have narrowed, squeezed by higher labor costs, rising ingredient prices, logistics expenses, and aggressive promotions used to keep customers coming in. While Starbucks once enjoyed operating margins comfortably above 18 to 20%, recent reports show margins slipping into the mid-teens, a meaningful decline for a company built on scale efficiency. That may not sound dramatic, but for a business of this size, even a 1-point margin drop represents hundreds of millions of dollars lost. The stock market has noticed. After peaking near all-time highs, Starbucks shares have underperformed the broader market, lagging major indices during periods when investors favored growth and consumer discretionary stocks. Volatility has increased, and long-term optimism has cooled. Analysts have quietly adjusted expectations downward, citing slower global growth and execution risks. When a company this large starts missing expectations, even slightly, it's a warning sign. Internationally, the picture isn't much better. China, once seen as Starbucks' biggest growth engine, has become unpredictable. Store traffic there has been uneven, consumer spending has weakened, and competition from local chains has intensified. Starbucks has been forced to lean on discounts and promotions in markets where it once commanded premium pricing power. That's not dominance, that's defense. So while the headline numbers still look big, the direction of the trend matters more than the size of the business. Starbucks isn't collapsing overnight, but the financial momentum that once made it untouchable is clearly fading. And when the numbers stop telling a growth story, everything else, from customer experience to brand power, starts to feel the strain. Here's the part most people miss. Starbucks' biggest problem isn't revenue, it's people walking through the door. Across multiple recent quarters, the company has acknowledged that transaction counts are either flat or declining, especially in mature markets like the US, Canada, and Western Europe. That means fewer customers per store per day. The revenue numbers only look stable because prices keep going up. In North America, Starbucks has admitted that average ticket size is rising while customer visits are not. This is a classic warning sign in retail. It tells you customers aren't buying more. They're just paying more when they do show up. Once price increases stop working, there's nothing left to hide behind. And globally, this trend is repeating itself. In parts of Asia and Europe, traffic growth has failed to recover to pre-pandemic patterns, even as operating costs continue to climb. Mobile ordering was supposed to solve this. Instead, it's created new friction. Starbucks now handles over 30% of US orders digitally, but stores are overwhelmed. Long wait times, crowded pickup counters, and order mistakes have become common complaints. Baristas are stretched thin trying to manage in-store customers, drive-through lines, and mobile orders simultaneously. When service slows down, customers quietly stop coming back, and Starbucks feels that loss one transaction at a time. Drive-through performance, once a major advantage, has also softened. In suburban markets, customers report longer waits and inconsistent quality, eroding the convenience factor that once set Starbucks apart. Convenience was the brand's secret weapon. When that disappears, loyalty weakens fast. What makes this more dangerous is how subtle it is. Traffic declines don't show up as dramatic headlines. They show up as missed forecasts, shrinking margins, and increased discounting. Starbucks is increasingly reliant on loyalty rewards and promotions just to keep foot traffic stable. That's not organic demand, that's artificial support. And when a consumer brand built on habit starts losing daily routines, it's a sign that something fundamental has shifted. People aren't loudly abandoning Starbucks, they're simply going less often. And in a business built on volume, quiet losses are the most dangerous ones. Starbucks has leaned hard on price increases, and customers have noticed. Over the past few years, menu prices have risen far faster than overall inflation. A drink that cost around $4 just a few years ago now regularly pushes $6 or more in major cities. Add customizations, which Starbucks actively encourages, and a regular order can easily cross $7 to $9. For many customers, that's no longer an everyday habit. It's a small luxury they're starting to question. What makes this risky is timing. These price hikes landed while global consumer confidence weakened and household budgets tightened. Wage growth hasn't kept pace with food and beverage inflation in many countries, and discretionary spending is under pressure. Starbucks is asking customers to pay premium prices at the exact moment people are becoming more price sensitive. That's a dangerous mismatch. Customer satisfaction scores reflect this tension. Surveys and app feedback show declining perceptions of value, especially in North America and Europe. Complaints about inconsistent drink quality, incorrect orders, and long wait times have increased. When people pay more, tolerance drops. A small mistake feels bigger when the coffee costs nearly $10. Starbucks built its reputation on reliability, and rising prices are exposing cracks in that promise. The rewards program, once a powerful loyalty engine, has also lost some of its shine. Changes to how points are earned and redeemed mean customers now need to spend more to get the same free items they once enjoyed. While this boosted short-term revenue, it frustrated longtime loyalists. Many now describe the program as less rewarding and more manipulative, undermining trust. Globally, the issue is even sharper. In emerging markets, Starbucks pricing increasingly puts it out of reach for average consumers, forcing the brand into a narrower, wealthier customer segment. That limits growth and makes Starbucks more vulnerable during economic slowdowns. Premium brands only thrive when customers feel the experience justifies the cost, and right now, many don't. Raising prices is easy. Maintaining satisfaction while doing it is hard. Starbucks is learning that lesson in real time. And once customers start asking themselves, is this really worth it? The answer doesn't always favor the green logo anymore. While Starbucks was raising prices and standardizing everything, something else was happening quietly in the background. Local coffee shops were getting better and more popular. Across North America, Europe, and parts of Asia, Independent cafes and regional chains have been steadily taking share, not through scale, but through identity. They offer better beans, clearer sourcing, unique atmospheres, and prices that often feel more justified. This shift shows up in consumer spending data. Even as large chains struggle with traffic, independent coffee shops have seen stronger visit growth in urban centers. Customers are trading consistency for character. A locally owned cafe feels more personal, more authentic, and often more aligned with community values. Starbucks, by contrast, increasingly feels corporate and interchangeable. One store looks like the next. Same menu, same layout, same experience. Quality perception plays a big role here. Specialty coffee has gone mainstream. Customers now understand terms like single origin, light roast, and ethical sourcing. Many local cafes roast in-house or partner directly with farmers, something Starbucks talks about but struggles to deliver at scale. When a small shop offers a better tasting drink for a similar price, Starbucks loses one of its last advantages. Technology has also leveled the playing field. Independent cafes now use mobile ordering, loyalty apps, and delivery platforms that once gave Starbucks an edge. Convenience is no longer exclusive. That means Starbucks has to compete on experience and value, areas where it's becoming less compelling. Globally, this trend isn't limited to the US. In Europe, cafe culture has always favored local spots. In Asia, regional brands are blending coffee with lifestyle branding that resonates more deeply with local tastes. Starbucks is no longer the default cool option. It's just one of many, and often the most expensive. This matters because Starbucks was never just selling coffee, it was selling belonging, the third place between home and work. But when customers find that feeling elsewhere, for less money and with better quality, the emotional bond breaks. And once that happens, Starbucks becomes just another coffee seller in an increasingly crowded market. Starbucks' future depends on younger customers, and that's where the warning lights are flashing brightest. Gen Z simply doesn't connect with Starbucks the way millennials once did. For years, Starbucks benefited from being seen as trendy, socially conscious, and worth paying extra for. That image is fading fast among younger consumers who are far more skeptical of big brands. Spending data shows that Gen Z visits coffee shops less frequently overall, and when they do, they're more likely to choose smaller, independent cafes or brands that feel more authentic. They value uniqueness, transparency, and experience over logos. Starbucks, with its corporate messaging and standardized stores, feels manufactured to a generation that can spot marketing tactics instantly. Social media tells the same story. Starbucks still appears online, but not as a cultural driver. It's no longer the brand setting trends, it's reacting to them. Viral drink hacks and limited time flavors may generate short bursts of attention, but they don't build long-term loyalty. Gen Z engagement is increasingly centered around niche cafes, aesthetic local spots, and brands that feel organic rather than mass-produced. There's also a values disconnect. Younger consumers care deeply about labor practices, sustainability, and corporate behavior. Starbucks has publicly branded itself as progressive, but ongoing union disputes and worker complaints have damaged credibility. When a company's actions don't match its messaging, Gen Z notices, and they remember. For a generation that prioritizes ethics alongside price, that inconsistency is costly. Affordability matters too. Gen Z is entering adulthood during a period of high rent, high food costs, and economic uncertainty. A near $10 coffee doesn't feel aspirational, it feels irresponsible. Many younger consumers now view Starbucks as something their parents buy, not a brand that represents their own identity. This isn't just a branding problem, it's a long-term growth problem. If Gen Z doesn't adopt Starbucks as a habit now, they likely never will. And when a legacy brand fails to capture the next generation, decline doesn't happen overnight, it happens slowly, quarter by quarter, as the customer base ages out and nothing replaces it. Behind the counter, Starbucks is dealing with problems that can't be fixed by marketing or menu changes. Labor issues have become one of the company's biggest structural weaknesses. Over the past few years, hundreds of Starbucks stores across multiple countries have pushed for unionization, citing understaffing, unpredictable scheduling, stagnant wages relative to workload, and burnout. Whether you support unions or not, the scale of the movement itself signals something deeper. Employee morale is cracking. Starbucks didn't become massive just because it sold coffee. It became powerful because it shaped culture. For years, Starbucks was the symbol of modern urban life, a place to work, meet, relax, and feel connected. That cultural role is fading, and once a brand loses cultural relevance, no amount of scale can save it. The third place idea is breaking down. Many Starbucks locations are no longer comfortable spaces to stay. Seating has been reduced, store layouts feel rushed, and the atmosphere is increasingly transactional. The focus has shifted to throughput and efficiency, not community. When customers feel like they're in the way instead of welcome, they stop lingering, and eventually they stop coming. Pop culture has moved on too. Starbucks used to be referenced in movies, TV shows, and social media as a lifestyle brand. Now it's rarely aspirational. It's seen as overpriced, corporate, and predictable. The brand that once felt cool now feels safe. And in cultural terms, safe often means boring. Even Starbucks' attempts to stay relevant highlight the problem. Limited edition drinks, influencer collaborations, and trend-driven flavors feel reactive, not innovative. They generate short-term buzz but fail to build long-term identity. Younger consumers can sense when a brand is chasing relevance instead of creating it. Globally, Starbucks' cultural disconnect is even clearer. In many markets, local coffee culture is deeply rooted, and Starbucks increasingly feels like an outsider. Instead of adapting meaningfully, the company often exports the same US-centric experience everywhere. That worked when Starbucks was novel. It doesn't work when it's everywhere. Cultural relevance is fragile. Once it slips, it rarely comes back the same way. Starbucks still has recognition, but recognition isn't the same as admiration. And brands that lose admiration slowly lose pricing power, loyalty, and influence. This brings us to the final question, and it's the most important one. Starbucks isn't going bankrupt tomorrow. Let's be clear about that. It's still a massive company with global reach, billions in revenue, and deep financial resources. But decline doesn't usually look like a sudden collapse. It looks exactly like this: slowing growth, weaker loyalty, rising costs, cultural drift, and a brand that quietly loses its edge. What makes this moment different is how many warning signs are flashing at once. Customer traffic is slipping. Prices are pushing against consumer tolerance. Younger generations aren't buying into the brand the way they used to. Employees are stretched thin and increasingly vocal. Competition is stronger, more local, and more authentic. And the company is relying more on financial engineering, price hikes, promotions, and rewards tweaks, instead of genuine demand growth. Historically, this is how dominant consumer brands lose their position. They don't fail because people hate them. They fail because people stop caring. The visits become less frequent. The excitement fades. The brand becomes a habit people slowly replace rather than defend. By the time the financial damage becomes obvious, the cultural damage is already done. Starbucks' biggest risk isn't competition or labor costs. It's relevance. If it can't re-earn trust with workers, reconnect with younger consumers, and deliver an experience that justifies its premium pricing, the decline will continue. And every quarter that passes makes the turnaround harder. The question isn't whether Starbucks will disappear. The question is whether it will become something far less powerful than it once was, a legacy brand living off past success instead of shaping the future. And when you step back and look at the numbers, the behavior, and the culture all at once, it's hard to ignore the possibility that we're watching the early stages of that transformation.